timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
Well, welcome back to the Chapman Business Report, our periodic look at the national, especially the regional economies of Southern California and economic trends and markets. I'm Pete Weitzner. I head up the broadcast journalism program just a couple of blocks to the east of us at Dodge College. And just adjacent, somewhat adjacent to Dodge, went up a few years before that, is Beckman Hall, where Dr. Essie Adibi applies his dismal science, heads up the Anderson Center for Economic Research. Of course, for many years, he and Jim Doty put out their very influential economic forecasts. You just did your 35th or 36th National. You'll do your revision in June. And in your state and regional forecast, even a little more optimistic. It was fairly optimistic for the nation, but a little more optimistic for the region.
Sure, because, you know, a state and the region, if you look at Southern California, we suffered quite badly in this recession. So if you look at job performance, our trough was much deeper. And coming out, we really underperformed, you know, the U.S. economy, California and Orange County, and for that matter, Southern California, 2007, 8, 9, 10, 11, we underperformed the U.S. when it comes to job creation.
Led by development, led by some nice capital gains
sure,
taxes.
if you look at like job
all
performance.
Those Northern California dynamos.
Oh, they're doing fantastic up there. If you look at job creation in 2012, that was the first year that California outperformed the U.S. And 2013, again, we're doing much better than the U.S.
And it's different than the U.S. in that we're getting the jobless rate down, some job creation, but a lot of people dropping out of the job force. Not quite as bad here.
Not as quite as bad, but it's still, that's a national phenomenon. If you look at every region of the country.
And troubling any way you look at it.
Yeah, it is a bad news that unemployment rate goes down for two reasons. Two reasons. One is a bad reason that people are leaving. The other one is obviously job creation.
Do you think it's more discouraged workers or more we've made it too easy for people? You know, at one time it was 99 weeks of unemployment. Yeah, still 26.
There are multiple factors.
Stay on your parents' health insurance till you're 26.
Yeah, that is not the issue. The biggest issue is, I believe, that there's a structural unemployment. That is, certain people who lost their job during this recession, let's say construction, I use that as an example. This person cannot quickly retrain and come back to the job market and become a computer programmer. So there's a structural problem that is mismatch of jobs, skills, and job requirement. That's part of it.
So with some good policy, we can reverse this.
We should have spent tons of money on re-education and retooling people.
All-time low for labor force participation, 63%.
63%, and it used to be 68%.
We'll go back to the good news to illustrate what you're saying about California. Jobless rate is still 8.3%.
Yes.
Still one of the highest in the country, but compared to the nation of 6.6%, and we were 12, 13, even a year ago, it was 9.8% in California. And you look back a couple of years ago, we had a deficit of $25 billion. Are we looking at a surplus this year?
Yeah, but let's come back to surplus. When you look at the unemployment rate, again, look at the peak and where we are. If you're over 12.5% and you're 8.5%, that's a drop of 4 percentage points in unemployment rate, roughly. And if you look at nationally, they were at 10% peak, and they're about 6.3%. So in a way, our unemployment rate dropped much faster, but it's still, because we were so bad, in a bad shape, we're still worse than the U.S. But geographically, Pete, something interesting to know that the coastal counties, most of coastal counties, they have unemployment rate which is below national average. I mean, Orange County is
we're 5.2%,
exactly,
which is one of the lowest rates if you take into account states. The Dakotas, Nebraska, with all the oil money.
Regionally, we're second.
5.2%. We've done better, but 5.2%. Orange County was 6.8%, and we've had 2.5% job creation.
Exactly. So we are doing better in Silicon Valley. We're doing in Orange County. We're doing much better in San Diego, and Bay Area is obviously is outshining everybody. All that technology, social
smell the
media.
Money up there.
Exactly. Now, going back to your original comment about deficit and surplus, obviously, you know. But what happened to our government, you know, budget is that, first of all, taxes, you know, got increased by the governor.
Sure. When Mr. What's the head of Facebook? When Mr. Mark cashes out, he pays a nice little capital gain.
Oh yeah, there's lots of capital gain. The economy is doing a little bit better. There is more job creation, so personal income taxes are growing. And at the same time, sales tax gone up, income tax rates have gone up. So yes, we turn from deficit to surplus. But remember, the surplus we're talking about is operating surplus. That is, we are not accruing for retirement plans. So yes, on year-over-year basis, we're going to be fine for the next 4 or 5 years. But if you look at our pension liability, and if you want to fix that, we have to accrue now like about $9–10 billion, and we're not doing it, which most economists and most observers are saying, hey, now that you're in good shape, let's accrue some money for those unfunded liability. If you do that, then we're going to be in bad shape, obviously.
Leading the way in Orange County, maybe some of the other coastal areas, has been leisure and hospitality, which is pleasing in many ways. It's outside money coming in, it's clean burning, so to speak. Let's look at hotels in Orange County in 2013. Occupancy up 3%, rates up 6%, revenue per available room's a big number, and hotels up 9%. It continues to become a bigger part of our pie here. Tourism, leisure and hospitality, business travel.
Sure, part of it is, of
John
course.
Wayne's had their biggest year.
Exactly. Part of it is, of course, the economy is doing better, so people have more discretionary spending, money to spend. And secondly, because some people cannot go overseas for vacationing, it's expensive, obviously. Even if you look at Euro, it's very expensive to go to Europe. So these people are traveling domestically, and what are the perfect destination for somebody who lives in North Dakota, or for that matter in Canada? They're coming to California, and they're going to North, obviously San Francisco area, Orange County, LA area, even in Palm Springs. If you look at number of foreigners visiting Palm Springs, I was there just a month ago, it's crowded, it's loaded with Asian tourists and Canadian tourists. So all of that is helping hotel occupancy, and the convention business is coming back, particularly for Anaheim. Because again, that goes with the business activity. So leisure and hospitality has been growth, sector, but for our audience, probably they would say these guys are not making that much money, and that's true. If you look at the typical wages and salaries paid in that industry, is below the average.
The income gap, definitely a topic for another time on a Chapman Business Report. By the way, I wanted to call Mark Zuckerberg Jesse Eisenberg.
Exactly, Mark.
But you can tell that I've been in Hollywood too long if I wanted to call him by the actor who played him. Now, I wonder if this gives you pause. Last 3–4 months, after a 4 or 5 year run up in home sales and home values, we're slowing down.
Yeah.
I look at the January numbers, Orange County and Southern California, sales down. In January, you can't blame this on the weather. I know it's not a big buying month. And then the median price continued to be up. But obviously, that's one of the reasons, right? Yeah. At $550, Orange County's now within 18% of that all-time high. We've made a lot of it back.
Exactly. As you recall our forecast when we issued it last November, we said the appreciation that we experienced in 2013 and 12 are not sustainable. And part of the reason...
You still see us going up
This is not a bubble. It's not going to burst.
Right.
But we don't see double-digit appreciation. If you look at Southern California, each area, we're seeing it between 5 to 7% appreciation. And there's some good reason. Most importantly is affordability. I mean, mortgage rates have gone up, not as much,
Come back a little bit, but they have gone up a full percentage point.
But it's still full percentage points from the low. And at the same time, income is not increasing as fast. So homes are not as affordable as they used to be, particularly in 2012. And then when you look at the inventory, a bunch of people who had homes, mortgages, which was underwater now, they're capturing that equity back, and some of those people start listing those homes. So the inventory is going to go higher, and more importantly, investors are absent.
Incomes have not gone up. Just one of the things we will take up on our next segment of sundry topics. Did the stimulus work 5 years hence? Should this movement to raise the minimum wage, is it a good idea or a bad idea? Should California increase incentives to bring film and TV production back? That's next time with the boss, Dr. Essia DB. I'm Pete Weitzner. Thanks for watching the Chapman Business Report.